Hello, traders. It's Friday, September 19th. We're pre-market here. Just want to mention a couple things that I think are really important. Last night, if you watched 60 Minutes, President Biden talked a little bit about Taiwan. He mentioned something that he would put in troops to defend Taiwan if China were to attack. That is pretty big news, saying that he would actually put troops on the ground. The White House is trying to walk it back, but the damage is done. We have put out a red line here now with Taiwan, and the question really becomes whether China is going to test. Given what has happened recently, I think China will test. I think this is going to have serious implications across the world, obviously, not just supply chains. It's going to affect currencies. It's going to affect stocks, bonds, etc. And obviously, the bottom line, the comment is inflationary, right? So we're all talking about inflation. When you see comments like this, you just know that it is inflationary. So what could this mean down the road? Higher rates, higher inflation. Obviously, very, very bad for stocks, and obviously very positive continually positive for the U.S. dollar, which is the last thing we need right now. The U.S. dollar, as I mentioned, and I'm going to keep mentioning it in every video going forward, U.S. dollar is the major issue. You could see here as a leading indicator, the Taiwan currency weakening fairly dramatically. It's been one of the strongest currencies for as many years as I've been following the markets. And right now, we've got a serious issue with Taiwan dollar, more as a leading indicator, saying there's something going on here, rather than just a kind of a one-off situation. Now, I want to mention something about my friends on Wall Street here. Wall Street's got serious issues. I'm talking about traditional Wall Street, investment banks, etc. The IPO market is in decline. It has been for some time. It's one of the worst in terms of the worst conditions we've seen in 20 years. This is the engine. This is the last engine of fees and revenue for Wall Street. The stocks, the equity business has been in decline for some time because of technology and electronic trading have driven commissions down to zero. This bear market, we are at the beginnings of a bear market in the bond market. This is devastating. The bond trading has been one of the bright spots and the engine of massive profits for Wall Street for 30 years. That's over. So what's left? Investment banking. And if we continue to have market conditions like this, which I think we will, I'm not talking about stocks down or up. I'm talking about just constant gyrating of markets. There's going to be very few IPOs. One to watch here is the Porsche IPO coming out this week. I think it's very important to watch because it's high profile. It's in Europe, where the conditions are worse than it is here. It is an expensive stock. I don't know what's going to happen but if you see this IPO break, it's going to confirm that the conditions are just very poor, and investment banks like Morgan Stanley, Goldman Sachs, continue to have really troubles going forward because of the lack of banking, the bond market, and the equity business being a loss leader. Mentioning here this with these stock market declines and consequently bond raises, we want to talk about here what we used to call TINA, right? There is no alternative. Why did stocks just continue to rise over this few-year period where rates were almost zero, or they were zero? Because of TINA. There is no alternative. Well, that's gone. As you can see here, rest in peace, TINA. It's over. Right here, I want to give you one indication why that, or a few indications why that it's over. Here you talk about terminal rates, right? Morgan Stanley thinks terminal rates are going to be approaching 5%. Why is that important? Well, the terminal rate is what the Fed is going to finally reach at, right? So the Fed is bringing up Fed funds. That's really short-term rates. That what that means is, as an investor, your money market rates, which were zero, are already starting to go up. And if you can get 3 or 4% on your money market, on the money on your cash, why would you invest in volatile stocks? The dividend yield on the S&P is a little less than, just about 1%. All right. So now riskless treasuries, right? Treasury funds, if they go to 3.5%, 4%, which I think everyone realizes they are headed to, and the 10-year, let's say, goes to 5%, 6%, how could stocks remain with a dividend yield of 1% or less? It's not going to, the dividend has to go up. What that means is stock prices have to come down. So this is a very bad news for stocks. Also for housing as well, and for just fixed income investors. Again, things are getting interesting again. If you look at this, the mortgage-backed securities spread to treasuries, that is skyrocketing again, and QT hasn't even started. So quantitative tightening is what the Fed should be doing. They say they were going to be doing. They're doing very little of it, especially in the mortgages. If they do start being more aggressive in QT, which they probably should, mortgage spreads will go higher. That means yields that are available to investors, especially large investors, which have been piling out of those bonds over the last few years, are going to pile back in. Again, more bad news for stocks. But here's some good news. Inflation, I've been saying, is peaked. Okay, whether it's 8%, whether it's 7%, it's going to be sticky, but I think we've seen a peak in inflation. I think we've seen that with a lot of indicators. If you look at used car prices, for example, or other indicators, used car prices are in free fall. New car inventories are up. Prices are starting to fall. Don't listen to the prognosticators. There's a lot of bargains. There's a lot of incentives for new cars. That tells you that the inventories for new cars are up. So used cars, new cars, prices are plummeting. That's positive. If you're looking for a new car, wait another couple of months to the end of the year, you're going to get it for 20% cheaper than it is today. So that's all. Also good news on the freight costs, right? If you look at again, this is supply chains. Freight costs are obviously have been inflationary for some time, especially obviously since the pandemic. That's declining pretty rapidly. That's also telling you that's going to show into the inflation numbers probably towards the end of the year. But it's not good news. This is all pointing to that we are peaked inflation. That's good, but at what cost, right? Demand. That's what really is killing us here. Another indicator I mentioned before about gasoline prices contributing to the decline in inflation, but this is manipulation. The White House has used a strategic oil reserve to try to manipulate inflation, and it's worked in the short term, but we won't see the results of this till the end of the year. Again, it didn't help the CPI last time, but it is going to help. But this is a manipulation, and again, very bad news that we've basically depleted, or we are depleting, our strategic oil reserve. So then it comes down to tomorrow. The Fed meeting tomorrow starts tomorrow. We're going to get the results on Wednesday. I think 75 bips are baked in, but I think by Wednesday morning we're going to be baking in 100 bips. Right? That's not good, but it's needed. Again, what does this all mean? The dollar. So whatever the stock market reacts, not relevant. You've got to look at the dollar is going to continue to go higher. The euro is below parity. The UK currencies is going to go to parity. All around the world, the implications are pretty dire when the US dollar has this type of strength. The US dollar is very overvalued. So that means in the short term, we may see some kind of correction. I don't know. But if historically, the US dollar is extremely overvalued. But the effects of the US dollar are lasting. If the dollar comes down a little bit tomorrow, it's not going to turn back all of the negative effects that happen to the dollar. Gold broken down. We've talked about it. I think the support level is 1,500. It could be lower. But gold at some point is going to be an interesting buy. But right now, gold is being affected by this. So is crypto. You've got a big break in Bitcoin today. But as I mentioned before, crypto itself is interesting only because Bitcoin versus the other crypto. If you can chart Bitcoin versus the other crypto, you want to watch that spread. You want these other cryptocurrencies to get pounded, because in order to Bitcoin to achieve the value that it should be trading at, you've got to get rid of all these speculative cryptos out there, and then Bitcoin may find a level, and that's probably going to be an amazing buy. So another indicator here, the treasuries. The treasuries are very oversold as well. I mean, the price of treasuries, the yields going up. Again, this points to possibly maybe a counter-cyclical rally. But everything points to this. The U.S. dollar is strong, and recession is already here, right? We've seen, we know it's here. I don't think anybody's going to doubt that over the next few months. Recession is being baked in. It's already happening in Europe. We're seeing it in Asia, especially China, and now obviously we're already in recession in the U.S. Global recession is not good for anybody. The U.S. dollar is really going to accelerate this even more, and I think it's something that certainly you got to be watching. So at the end of the day, we got the Fed meeting this week. Stronger dollar, not good for stocks, not good for bonds, not good for anything. Anyway, happy trading.